Bitcoin's brutal plunge from $125,000 to $77,000 erased billions in market value overnight. It shattered a deeply held illusion about what this asset actually is. For years, retail investors bought into a very specific narrative. Bitcoin was digital gold. It was sold as a pristine, independent asset that would protect your wealth when the traditional financial markets panicked. The reality is completely different. While the crypto markets bled out, Wall Street tech stocks, specifically in the artificial intelligence sector, experienced a massive, coordinated explosion in value. This dual line chart from KuCoin proves exactly how tethered Bitcoin is to the legacy system. When we map Bitcoin's price directly against the IGV software ETF, we see a staggering 0.73 correlation. Look at the sharp October sell-offs, where both of these assets plunged in perfect synchronization. That correlation officially terminates the idea of Bitcoin as a rebel currency. It now trades like a highly sensitive tech stock, completely at the mercy of institutional money managers. The blockchain no longer dictates the price. Instead, Bitcoin's value has become an output of two specific external forces: physical AI infrastructure and global monetary policy. Right now, the artificial intelligence sector is undergoing an infrastructure build-out projected to hit $500 billion by 2026. That immense capital expenditure acts like a financial vacuum, pulling risk-on capital directly out of the crypto markets. This drain goes far beyond investor capital. AI companies are aggressively taking over the physical hardware and energy grids that keep the Bitcoin network alive. Look at major Bitcoin mining operators like TeraWulf. They are actively pivoting away from cryptocurrency extraction to lease their massive, energy-dense facilities to host AI neural networks. As a result of that pivot, their stock prices soared up to 85% this year. The artificial intelligence boom is cannibalizing the crypto industry from the inside out. It's actively starving the Bitcoin network of the servers, the cheap electricity, and the speculative cash it needs. That explains the tech side of the crash. But there is a second, even larger macroeconomic force at play. Investment strategist Lynn Alden recently analyzed the data and proved that Bitcoin's price is entirely dictated by global M2 liquidity, the total amount of cash and short-term bank deposits circulating in the world economy. This overlay chart demonstrates the expansion and contraction of that global M2 liquidity over time. Notice the alignment. 83% of the time, the Bitcoin price line acts as a perfect mirror to the M2 area volume. They move in the exact same direction. When central banks tighten their policies and restrict that money supply, they suffocate the market. You can see the M2 area drop here, violently pulling Bitcoin down with it during the crash. This data reframes Bitcoin as a global liquidity barometer. It functions as an extension of the dollar supply, expanding and contracting based on the volume of fiat currency central banks pump into the system. This brings us to the future. Bitcoin's next massive recovery relies entirely on external triggers. The first required catalyst is a popping of the $500 billion AI bubble. Right now, the tech sector is spending $400 billion to generate just $60 billion in revenue. When that poor return on investment finally fractures the AI market, we will see a violent rotation of capital out of tech stocks and back into alternative assets. The second catalyst is the return of a policy called QE Lite. We need central banks to officially end their tightening cycles and inject trillions of fresh dollars back into the financial system to lower borrowing costs. Until those two things happen, Bitcoin's destiny is entirely out of its own hands. The entire asset class is forced to wait on the sidelines for artificial intelligence to fail, or for central banks to ease up. This reality, that Bitcoin is now a correlated Wall Street integrated tech stock, is causing a deep fracture among true crypto believers. Because Bitcoin's ledger is transparent, institutions and governments can track every move, effectively neutralizing its original purpose as an alternative system. Investors seeking to decouple from this institutional tracking are rotating capital into Zcash. Unlike Bitcoin, Zcash uses zero-knowledge encryption to shield transaction details, offering an escape from the surveillance that now defines the major chains. This demand drove an explosive 1,800% price spike in Zcash. Veterans treat shielded coins as insurance against Bitcoin's bank integration. Today, 27% of Zcash sits in the shielded pool, proving whales are prioritizing privacy to break that 0.73 software correlation. Surviving the 2026 market requires a shift in focus. Ignore Bitcoin charts, watch the AI bubble, and listen for the central bank money printer.